The Indian stock market is bleeding. Over $1.3 trillion in market value has been wiped out, and foreign investors are making a sharp exit. What's causing this panic? And more importantly, is this just a phase, or are we staring at something much worse? The once unstoppable Indian stock market is now in slumbers. Investors are worried, traders are anxious, and the numbers, well, they speak for themselves. Let's break it down. Foreign institutional investors have pulled out billions of dollars from Indian equities. The Nifty 50 and Sensex are on a downward spiral, wiping out significant market cap. Major stocks, including blue chip companies, are seeing a sharp decline. But why? What's driving this sell-off? Well, number one, US Federal Reserve's hawkish stance. The Fed is keeping interest rates high, making US bonds more attractive than emerging markets like India. This leads to a global shift in capital away from riskier markets. Number two, geopolitical tensions and oil prices. Rising crude oil prices are squeezing corporate profits in India. Conflicts in the Middle East and Russia-Ukraine war are fueling uncertainty. Number three, weakening rupee and economic concerns. A depreciating rupee makes Indian investments less attractive for foreign investors. Concerns over India's fiscal deficit and global recession fears add to the panic. Number four, earnings season disappointment. Many Indian companies have reported lower than expected earnings, leading to further sell-offs. Sectors like IT, banking, and consumer goods are feeling the heat. Number five, policy uncertainty and upcoming elections. With major elections around the corner, policy uncertainty is making investors cautious. Market participants are wary of potential regulatory changes and fiscal policies. So who is getting hit the hardest? Well, number one, tech stocks and startups. High valuation stocks are the first to suffer. Number two, banking and financial sector. Rising interest rates impact loans and credit demand. Number three, retail investors. Small investors are seeing their portfolios turn red. Number four, real estate and infrastructure. With credit tightening, large projects could slow down significantly. Number five, export-oriented sectors. A weaker rupee might help exporters, but global demand is slowing down. Experts say this correction was long overdue. Markets were overheated, and foreign investors always look for better returns. The good news? This could be an opportunity for smart investors. So what should you do now? Don't panic. Markets are cyclical. Avoid risky bets. Stick to fundamentals. Diversify. Consider gold, bonds, and global investments. Look for value stocks. Corrections bring opportunities. Keep an eye on central bank moves. RBI's actions on interest rates and liquidity will be key. Stay invested for the long term. Short-term turbulence shouldn't shake long-term goals. Historically, the Indian market has seen several corrections, but long-term growth remains strong. The key drivers for recovery could be government stimulus and policy support. If the government introduces new reforms or stimulus packages, stabilization of global markets, if inflation cools and central banks ease policies, domestic consumption and growth, India's growing middle class and demand-driven economy could fuel the next rally. Attractive valuations, lower stock prices could attract both domestic and foreign investors back into the market. The Indian market might be down, but it's far from out. History shows that crashes often pave the way for new growth. But what do you think? Will the market bounce back, or are we heading for deeper trouble? Like, share and subscribe for more stories around the globe. Don't forget to visit manishgoswami.com, and thanks for watching. I'll see you in the next one.